Trade finance, what's happening in the world? I don't know. Interesting. Supply chain trade finance is a major change, and the developments in supply chain versus trade, let's say, letter of credit is important. The role of supply chain trade finance versus open account is equally vital. How are OCR and ML brought to supply chain trade finance vital? Let's also look at how the COVID has impacted the trade finance. Blockchain is impacting the trade finance. How the logistic companies building trade finance is very vital now. It's a huge transformation. Supply chain trade finance is a product that is used by large and mid-sized corporate importers to get efficient trade finance into their international supply chain. Trade finance has a simple task to perform. Get exporters paid when they ship and allow the buyers to pay later. And that's the model. Trade finance bridges the cash flow gap. If you look at the big picture, they bridge the cash flow gaps. Banks' trade finance products like the letter of credit have declined in popularity due to their complexity, because that requires documentation, the review, legal. They are complicated to use, often require considerable expertise, and this leads to time delays on payments and expensive fees. So nobody wants the conventional trade. Supply chain trade finance delivers the same results as the letter of credit, but without complexity, cost, or delays that can be involved. So supply chain trade finance is the solution. Institutions who are not recognizing this opportunity as a financial service provider, you will lose your market share slowly but steadily. Even if you look at India, many Indian companies are using they are still using LCs, unlike the European and US counterparts. Now, supply chain finance is defined, let's understand the meaning of it. It's defined as the use of financing and risk mitigation practices and techniques to optimize the management of the working capital and liquidity invested in supply chain process and transactions. Supply chain finance is typically applied to open account trade and is triggered by supply chain events, scheme of events. The visibility of underlying trade flows by the finance providers is a necessary component of such financing arrangements, which can be enabled by a technology platform. You need a technology platform. So use financing and risk mitigation practices and techniques, optimize it, and to your advantage to gain more working capital and liquidity. Now, account receivable is legally enforceable claim for payment held by a business entity against a customer for goods and supplied, or even services rendered in execution of the customer's customer order, I should say, and is recorded on the balance sheet. So once you do that, off balance sheet you put it, or on balance sheet you put it settle. If there is a real liability, if it's a contingent liability, you put off balance sheet. Such claims generally take the form of invoices raised by a business and delivered to the customer for payment within an agreed time frame. Within the time, it has to be settled. Account receivable discounting is a form of a flexibility applied receivable purchase in which the settlers, if you look at the, so I am buying or selling, let's say sellers of goods and services sell individual or multiple receivables, whatever be the outstanding invoices, to a finance provider at a discount, obviously, because there's an interest element involved. Money is going to come early to you, you discount it. What's the role of the supply chain trade finance if I compare it with the open account? The most global trade is conducted nowadays on open account, which typically means that the exporter ships and trusts the buyer to pay him later. Full stop. They give the measured risk. They take the credit risk. The most recent ICC report on global trade finance suggests that approaching 90% of the trade now is an open account. Similar savings are also available, switching from open account to supply chain trade finance as well, as more expensive supplier finance can be substituted by an efficient funding program organized on a central basis. You have central repository of all the buyers and sellers, and they settle. They know who is buying, who is selling. And there are significant developments that are pushing corporates towards adopting the technologies towards this supply chain trade finance for the international supply chains. Most notably is the increasing pressure on corporates around the world to enhance their environmental, corporate and social responsibility, what we call it as ESG, and take great care on how their suppliers are funded and paid. That's vital. Now, this can also be at the heart of the ESG strategy, supply chain trade finance, since this trade finance platform can be used naturally to collect information on each supplier, their credibility, each shipment, and even the deep tier suppliers to the supplier. Now, it's important that suppliers to supplier, if you look at it, also transactions can take place. Now, let's talk about the optical character recognition, what you call OCR. The increasing capabilities of optical character recognition is important. Machine learning is important. These two systems are being integrated into the supply chain trade finance system. That's a huge development. Once in place, this allows corporate importers to specify the wide range of documents and information that they would like to have their suppliers to provide, and to have this uploaded platform and converted into structured data. For the first time, corporates are able to see what is going on in their supply chain in real time, and without having to install expensive, complex, procure-to-pay systems, and having more mobile their logistic business to a single provider. So what you need is optical character recognition, machine learning, that will help you. So let's also look at how the COVID has transformed the trade finance. The escalation of freight charges and the disruption of the trade that is being caused by geopolitics and COVID. We have seen this in the last 1.5 years. This should relatively a temporary matter, in my opinion, but it is important to note that these additional stresses on supply chains all add to the burden on the supplier, and it's important for larger and mid-sized corporate importers to take increasing care on how their supply chains are operating. The supply chain should be an asset, not a source of risk. If you look at the blockchain, the main use case for blockchain is in smart contracts rather than as a way to migrate fraud or introduce trust systems where trust was previously lacking. Blockchain networks are still struggling to take off in comparison to the increasing use of profile in the industry or blockchain-based shipping documents. That's a huge transformation. Blockchain is going to change the game. This latest step into undoubtedly a good thinking and will work. It will work. It's important. Blockchain networks are still struggling to take off in comparison to the increasing use, in the profile, but eventually it will work. If you look at the logistic companies, there is increasing activity among the logistic companies to look at building trade finance into their products. The merger of trade finance and logistics has been long discussed because they need export and import. But if they build a system into it, but it has always been difficult because the complexity of the traditional banking products like LCs, because a lot of internal nuances. With the new supply chain trade finance products emerging into the mainstream market, it's coming to the mainstream already. The logistic companies, particularly large global freight forwarders, are now mobilizing to take advantage of it. The time when the exporter gets paid upfront by its logistic provider as he ships, while the buyer pays, you ship it, pay later after delivery. Now it's not far away, and that's going to happen. Already big corporates are trying this, and they have been very successful in doing it.